Hello and welcome to another presentation on IND AS. So today we are here to present about IND AS 10, which covers the events after the reporting period. So we'll quickly have a look at the agenda and then we can move forward. So what we're going to cover today. So objective, what is the objective of this IND AS? The scope. What is the definition of the reporting period? What is the definition of the adjusting event and non-adjusting event? How IND AS 10 is dealing with a situation when we are doing the assessment for the going concern, and we'll also touch base about the same that how it is being represented in IND AS 1, which is the presentation of the financial statements. What is the treatment of proposed dividend, which is normally an event which is after the reporting period. Events requiring the disclosure only, what are those events? We'll also touch base upon the events which is having the impact on the earning per share. And then we'll also touch base about the differences between the IND AS 10 and the IAS 10. So we'll quickly move to the first slide then. Okay, so we'll quickly cover the objective of this IND AS 10. So objective is that whether an entity should adjust its financial statement for events after the reporting period or not. So which means that there are certain set of events for which we need to make some adjustment, and there are certain set of events for which we do not require any adjustment in the financial statement. We do require just require to disclose the impact of those in the financial statement, if at all the impact is material. We also need to look at the impact of whether the entity is going to have assessment of the going concern, because if you remember and recall the IND AS 1, wherein we talk about the assessment, so it specifically talk about that assessments will be done when the financials are getting approved in the board meeting. So which means that we need to at least have the future 12-month impact starting from the day when the financials are approved, and not from the date when those are reported. So we are going to touch base upon that. This scope is this standard shall be applied to the accounting for and disclosure of the event after reporting period. And if we try to compare it with the IAS 10, the scope and the objective for both IND AS 10 and IAS 10 are largely the same, and there is no gap to that. So we'll touch base upon each of this definition, that what is the reporting period, what are the adjusting event, what are the non-adjusting event, and how the assessment of going concern is being done, and how IND AS 10 is helping us to take care of the cognizance of those events which is impacting the going concern assessment itself, and then how we are going to align with the IND AS 1, which is the presentation of the financial statements. So we'll move to the next slide then. Okay, so let's just spend some time in understanding the concept of reporting period. The financial year for which the financial statements are prepared is largely the reporting period. So if we talk about the India context, so our reporting period is largely the 31st March of the financial year for which financial statements are prepared. For example, if FY 24-25 reporting date is 31st March 2025, events after the reporting period are the events between the reporting date and the date the financial statements are approved. This is most important. So which means we are preparing the financials for a certain set of period, and our reporting date is the last day of the financial year, which is like 31st March 2025 in context to India. And as per the Companies Act and as per the requirement of the SEBI, the quarterly financial needs to be approved within 60 days from the last day of the financial year. So which largely means that we are talking about 30th May as the date when the board meeting should happen, and that is the board meeting in normal scenario wherein the accounts are adopted, financial accounts are adopted. So which means that any event which occurs after 31st March 2025 and the board meeting in which financial accounts are adopted is the events which normally fall under the ambit of the IND AS 10. So these are the event which occurs after the reporting period, but between the before the financials are getting approved by the board. So event occur, after the reporting period, those events favorable and unfavorable both that occurs between the end of the reporting period and the date when the financial statements are approved by the board of director in case of the company and by a corresponding approving authority in case of any other entity. So which means there are certain instances wherein the financial after getting approved needs the approval of the shareholders as well, or after the approval of the board they needs to be approved by certain set of financial committee as well. So in both the cases wherever this has happened, for all the practical purpose and for the purpose of the IND AS, it is being assumed that the date when it is being approved by the board of directors is the date when it is assumed to be issued as a approved financials from the management side. So we'll quickly touch base upon those two aspects, and then we'll touch base upon the two critical definition of the adjusting and the non-adjusting event. So we'll move to the next slide then. Okay. So in the last slide, we touched base upon that. And again, the process involved in approving the financial statements for issue will vary depending upon the management structure, statutory requirement, and the procedure followed in preparing and finalizing the financial statement. So basically two instances has been highlighted here. In some cases, an entity is required to submit its financial statement to its shareholder for the approval after the financial statement have been approved by the board of the issue. And second one, in some cases, the management of an entity requires the issue's financial statement to supervisory board made solely for the non-executive for the approval. So in which means both the cases, once it has been approved by the board of directors, it has to be submitted for the approval of the shareholders in the first case, and second case it has to be approved to the separate body which is like supervisory committee for approving the financial. But in both the cases, what has been said that once it has been approved by the board of director, it is assumed that it has been issued as a financial statement which are approved. And for all the practical purpose, an event on the last day of the financial year till the date in which it is being approved by the board of directors are only the period in which any adjusting or non-adjusting events needs to take a cognizance of as per the IND AS 10. So these are like just for the information purpose, but largely thumb rule is that any date, any event which happens after the reporting date and the date in which financial statements are approved by the board of directors, any event that happen both favorable and unfavorable, that will trigger a kind of an adjustment in the financials or disclosure in the financial. So which normally we call as an adjusting event or non-adjusting event. We'll speak about that in detail in the next slides. Okay. Now we'll touch base upon the most critical definitions of this standard, which are the adjusting and non-adjusting event. So before coming to that, we'll quickly just recall what has been discussed till now. So we have discussed about the concept of the reporting period. We have discussed about the concept of the approval of the financial statements, and we have understood that an event which arises between the period whenever reporting date between the reporting date and between the time when the financial statements are getting approved is the period in which any event will if trigger would be treated as the adjusting event or non-adjusting event. Now what are the adjusting events? Those that provide evidence of the condition that existed at the end of the reporting period. Adjusting event are the reporting period are the adjusting event. So basically any any material information or any information, not material, any information that will impact the condition that existent on the reporting date, and if at all there is some changes in those conditions between the last day of the reporting between the reporting date and the approval of the financial, it requires an adjustment in the financial. So we'll talk about that what is the treatment of the adjusting event. So we'll have all the examples also, but for clarity let me just quickly give you one example. For example, if there is a long term relationship with one of our customers which was in strain as we close our financial on 31st March 2025. I'm taking example of 31st March 2025. So there were some challenges and some strains in the relationship with the customer, which has direct impact on our receivables. So though that condition was not enough to create a provision in the books of accounts as on 31st March 2025, but let's say between 31st March to 2025 and before the financials got approved, let's say by 30th May 2025, certain event happened, which means that let's say that receivables or the customer becomes has declared the insolvency, so which means that we need to create the provision for that. So this is an event for which the condition was there in my financials as on 31st March 2025, and this particular information has a negative impact on that condition. So which means that a proper adjustment is required in my financial to disclose the impact of that in the books of accounts. So this is a typical example of the adjusting event. So those that are indicative of the condition that arose after the reporting period, non-adjusting event or the non-adjusting event. So basically, non-adjusting events are the event for which there is no condition that exists, right? And we do not have a clarity whether that condition would exist in the future or not. For example, if let's say we have done the investments in some equity stocks, or let's say we have done some investments which are of my current investment, for which the fair market value was different. And let's say on 15th of April 2025, some market collapse has happened, because of which the fair value of that particular investment has reduced tremendously. So which means that that condition was never there on 31st March 2025. There was no indication, there was no condition that talks about the happening of that event, because of which the market got crashed. So which means that though our investment has fallen substantially because of the where fair market value has reduced, let's say to the extent of 80%, still it do not require any adjustment in the books of the accounts. We need to disclose this because the impact is material, and that disclosure is required to be made in the proper notes to the account as per the requirement of the standard. So which is that notwithstanding anything contained above, where there is a breach, one more thing which we want to highlight is that notwithstanding anything that contained where there is a breach of the material provision of the long-term loan arrangement or on before the end of the reporting period, with the effect that liability becomes payable on the demand on the reporting date, the agreement by lender before the approval of the financial statement for the issue to not demand the payment as a consequence of breach shall be considered as an adjusting means. What does this mean? So if you recall, when we were talking about the IND AS one, wherein we were talking about the presentation of the financial statement, and there was one point that came up very categorically, then when we classified any particular liability as a long term or short term, it has to be again depend upon certain set of criteria. And we also talked about the fact that if at all any breach of the terms of the contract do not by default make any long term liability to my current liability, the unless and until it has been specifically called out of that in the contract itself. So in which case, if let's say there is a clause in the contract itself, then breach in the clause of the agreement would make that liability payable on the demand. So in that case, it required an adjustment in the books of the accounts, because that will then be treated as an adjusting event, and hence we need to accordingly make those adjustments in the books of the account, and we need to also reclassify the liability from the long term to the current liability. But if particular that clause is not mentioned in the loan agreement, wherein it says that any particular breach would lead to the liability becomes payable on demand, then there is no need to classification change as well. It will still be shown as the long-term liability in my books of accounts as a long-term liability in the on the closing day of my reporting period. So there would be no change. It would only arise when there was a specific breach, and that breach demands, as per the agreement of the loan, that the liability becomes payable on the demand. So we'll move to next slide and see what is some more in some definitions, and then we'll quickly jump to some examples which can clearly showcase how that adjusting event and non-adjusting event needs to be treated. Okay. So we'll speak about adjusting and not adjusting. We spoke about that, and now we'll quickly look at the recognition and the measurement of these in the financials. So event occurring after the reporting period includes all the events up to the date when the financial statements are approved for an issue. We have discussed that. Even if these events occur after the public announcement of the profit and loss account of the stuff, which means that even if we have disclosed our financial, or let's say information has been made available public, still any event which happens after the disclosure of those public related information till it is finally approved still be considered as the event occurring after the reporting period, and will require the adjustment depending upon whether it is adjusting event or non-adjusting. So for adjusting event, what is the process? An entity shall adjust the amounts recognized in its financial statement to reflect the adjusting event after the reporting period. But for non-adjusting event, an entity shall not adjust the amount recognized in the financial statement to reflect the non-adjusting event after the reporting period. So what is it that required for non-adjusting event? Depending upon the non-adjusting event, it has to be looked at it whether the impact is material or not. If it impact is material, then we need to disclose that. But if it is immaterial, if it does not impact the decision making of the required stakeholders, then we should not disclose that event. But for material event, we need to disclose it. But for any adjusting event, it has to be adjusted in my books of accounts and the financials. So we'll quickly go to next slide and look at the examples of adjusting and non-adjusting event. Okay, so we'll quickly have a look at some of the examples. Few examples for these adjusting events. So example one, court case settled after the reporting date. So on 31st March 25, a legal case existed with probability of loss. 24, which is the 20th April, court judgment confirms that company must pay 10 crore. Condition existed at the reporting date. Hence, we have to adjust it because provision must be recognized or adjusted because there was already a condition or the event that existed on the 31st March 2025. So legal case was there already. Bankruptcy of a customer after reporting date. Debtor already facing the financial trouble on 31st March 25, filed the bankruptcy on 24th. So we discussed about this. Example 3 is the inventory valuation. Post-year sales shows the inventory was defective on 31st March 25. Inventory NRV must be reduced, net realizable value. Fraud detection after the reporting date. Fraud occurred on 24-25. So that means condition event was already there in 24-25. And then we have to, if it got discovered in 25 before the approval of the financials, then it has to be disclosed. Not disclosed, in fact, adjusted. And impairment indicators. Customer lost major contract in March but announced in April. And hence, so if you look at the genesis of the testing event, there was a condition that was already existed in the 31st March 25, which is the reporting date. And those conditions got further negated or strengthened on the happening of an event. And because of that, we need to make the adjustment in the financials. So this is the genesis of the adjusting event. That condition should be there on the reporting date or the in the financial year in which reporting date is being taken. For example, if you're talking 31st March 25, that is the last date, but any condition that existed in the 24-25 or before then that as well, which was further affirmed or negated, then it has to be adjusted in the books of accounts or the financials. So what are the examples of non-adjusting events? Do not adjust in the financial statement, disclose if material. Simple rules. We discussed that about that in the last slide, wherein we were saying that what is the recognition criteria for non-adjusting event. So we do not need to adjust any financials. We need to disclose if it is of material. Example one, fire after the reporting date. Factory burns on 15/4/25. No contract, no condition exists earlier. No adjustment. Disclose effective the material. Major business combination acquisition decided on 10th of May. Disclose only. Significant fall in the market value after 31st March 25. No adjustment required. Disclose if material. Dividend declared after reporting date. Dividend declared on 26th, 20th of June for 24/25. Reporting date is 31st March. Do not create liability because it was never existed at the time when we were closing our books of accounts. A significant loss passed and the new tax rule announced on the 5th of June or 5th of May, whatever the case may be. So no adjustment required because never no conditions there existed. So I think with this, we now have a clarity whether the event is adjusting or non-adjusting and how we have to treat those adjusting and non-adjusting events. So we'll quickly move to the next slide then. Okay. Now we'll talk about the another critical and most important aspect of IND AS 10, which is like impact on the going concern assessment. So we know that, and we have discussed in detail when we were dealing with IND AS 1 presentation on the financial statement. We talked about in detail that what is the concept of the going concern, and whenever we are preparing our financials, the mood principle is that we have to assume that it is a going concern. But if at all there are challenges in terms of the concern itself, which do not, which the conditions are there that it seems to be that it is very difficult for organization to operate, then definitely our books of accounts should disclose that. And it has to be kept in mind that when we are talking about the going concern, we are not talking about the events which are there on my reporting date, but the date when the financials are approved. So which means that any event which were not there on 31st March of 25 or in for any financial year, but that event came into light after the reporting date, but before the financial statements got approved, then it has to be adjusted accordingly. And in fact, the fundamentals of accounting needs to be reshaped to cover that impact on the financials itself. One thing also needs to be kept in mind that whenever we are doing the going concern assessment, it has to be futuristic. So we specifically talked about them in our India's one presentation, where we said that at least 12-month future assessment needs to be done or looked into when we are talking about the impact of the going concern. So with this, let's quickly look at what is being here, and then we'll try to cover some of the important aspect of the going concern. So an entity shall not prepare its financial statement as a going concern basis if the management determines that after the reporting period, either that it intend to liquidate the entity or cease trading, or it has no realistic alternative but to do so. Which means that the accounts should not be a financial should not be prepared on the concept of the going concern basis if the management itself confirms that there are certain events because of which the going concern assumption needs cannot be validated. What can those be? Deterioration in the operating result and financial position after the reporting date may indicate a need to consider whether the going concern assumption is still appropriate. If the going concern assumption is no longer appropriate, the fact is so pervasive that the standard requires fundamental change in the basis of accounting rather than adjustment than our amount recognized within the original basis. So basically, all the adjustments, all this impact, all the change in the fundamentals of the accounting needs to be done in the financial statements, even if that event was not there on 31st March of 2025 or the any other financial year. So which means that entire accounting needs to be reframed, considering that the accounts are not going to get prepared on the assumption of the going concern basis. India's also requires that, in fact, India's one also requires that the disclosure aspect for those. So specific disclosure are required for the financial statements which are not prepared on the going concern basis, and management is aware of the material uncertainties related to the event or condition that may cast significant doubt about the entity's ability to continue as a going concern. The event or the condition required disclosure may arise after the accounting reporting period. Even if financial statements dated 31st March 25, management must do the assessment uh, if my approval is happening post that, which normally happens within 30 days as the last date. But any board meeting can happen before that, and financial approval of financials can happen in that meeting. So it means that any date which is after my reporting date, but before the financials are approved, if an event triggers the fact that there is a challenge in assuming the going concern, that necessary disclosures and adjustments needs to be done, and those disclosures needs to be aligned as per the IND AS 1 requirement. So we'll move to the next slide and see what are those events which trigger the reassessment of the going concern basis assumption. So we'll go to the next slide and look at those triggers. Okay, so we'll spend some time and look at the triggers point because of which the revalidation of the going concern assessment has to be done. So loss of the major customer, because it has the impact on my revenue, entire revenue, which means that show pre-existing operational weakness, and hence this require an adjustment, and my going concern assessment has to be again revalidated basis this adjustment or this new event. Loan non-renewal by bank. For example, if let's say we were operating or organization were operating with 80% facility which is being available from the bank, and if it has not been renewed by the bank, which means that there is operational challenges in terms of operations cannot be managed. And this is a significant event which triggers that there is a financial stress in the reporting date, and hence we have to make the reassessment for the going concern assessment, and all these are adjusting events. Cash flow crisis or default reveals the pre-existing liquidity issues. Insolvency admitted confirms that insolvency existed. Loss of the key license, again operational challenge. Major legal judgment, which means that it has a direct impact on my operation and the ability at which I am performing my business. Discovery of the fraud existed earlier, hiding distress. So which means that there were fundamental challenges that were existing on the reporting date which were not brought to notice, but some trigger happened because of which those got highlighted after my reporting date but before the financials got approved. All these events definitely are the adjusting events, and my financials needs to be adjusted, and also the reassessment of the going concern basis has to be done basis the requirement of IND AS. So we'll move to the next slide then. Okay, now we have discussed in clarity that assessment is required basis the going concern and because of the adjusting event. However, An event can also be non-adjusting, but still it requires the assessment of the going concern. Right. So we spoke about the examples wherein the events were adjusting and hence they required the adjustments in the financials, and hence those requires a kind of adjustments and reassessment of the going concern. But these there are certain events which do not require the adjustment in the financial, but it requires the disclosures as per the requirement of IND AS 1 on an assumption that there are some challenges in the going concern. So which are those events? So so basically we have to make be very clear. So we talked about a going concern as a concept. It is being guided by the IND AS 1. We specifically talk about the conditions under which going concern assessment has to be redone and it has to be disclosed. Now in the AS10, when we are talking about, so there are two set of the events, adjusting event and non-adjusting event. And if all both of these events require reassessment for the going concern, it has to be dealt. The treatment of the event will be dealt as per IND AS 10, but disclosure requirement will be dealt as per the IND AS 1. So in this case, we are saying that there are events. So we talked about two events, adjusting events, which definitely require the reassessment. So which means that disclosures are required plus assessment, reassessment of going concern along with the adjustment in the financial. Now we are talking about those events for which there is no adjustment required in the financial. It requires the disclosure depending upon the fact whether it is material or not and the impact of that adjustment in my going concern. We have to disclose those impact as per the IND AS 1 if it is challenging my going concern assumption. So what are those events? So major fire destroys factory on 10th April. Fire occurred after the reporting period. No adjustment on the asset to disclose a material non-adjusting event, non-adjusting. So government unexpectedly ban government unexpectedly bans company's core product. Ban is new condition after the 31st March. No adjustment, disclose impact and uncertainty on the going concern. Likewise, sudden cancellation of the critical long-term impact. No adjustment, disclose the significance and post-elimination date and the impact on the going concern. So all these examples which has been listed here are the example wherein we require to reassess the consumption of the going concern, but these are not necessarily adjusting event because there was no condition that existed on my reporting date. So absolutely there was no indication and hence these conditions are considered as a non-adjusting event in the purview of IND AS 10, but it requires the assessment of the going concern considering the impact of IND AS 1. So events non-adjusting but still impact assessment is required for the going concern are these are like some of the example that has been showcased here. Bank suddenly cancels the credit lines, major customer goes bankrupt, post-year political unrest caused shutdown of the operation, unexpected litigation, key supplier suddenly becomes insolvent, sudden cancellation. So again, when we look at these are the event for which the condition was not there on the reporting date. And hence, these are construed as non-adjusting event in the purview of IND AS 10, but it requires the assessment of going concern as per the definition of IND AS 1. So I think this point has been made clear now. So we'll move to the next slide. Okay. Now we'll quickly talk about dividend. So if an entity declares dividend to holders of the equity instruments as per the definition of IND AS 32 after the reporting period, entity shall not recognize those dividends as a liability at the end of the reporting period because the decision was taken at the board meeting and there was no condition that existed on the reporting date. So which means that I do not, organization do not require to book any liability for those proposed dividend. If dividend are declared after the reporting period, but before the financial statements are approved for the issues, the dividend are not recognized liability at the end of the reporting period because no obligation existed at that time. Such dividends are disclosed in the notes to the accounts as per the IND AS 1 presentation of the financial statement. Likewise, it depends on whether the event exists on the end of the period or not. So sometimes an entity distributes the assets or do not give the cash but give that asset that requires a disclosure as per my IND AS 1 wherein we need to disclose that what is the amount of the dividend that has been given to the owners and it requires the disclosure plus the representation has to be done in my SOCE, which is my statement of change in equity. So very simple thumb rule as per IND AS 10 there is no adjusting event for the proposed dividend which is being proposed in the board meeting. So we'll move to the next slide. Okay, now we'll quickly talk about the disclosures. So we know that disclosures are required for again two set of the events, which is adjusting event and which is non-adjusting event. So date of the approval for the issue, an entity shall disclose the date when the financial statements were approved for the issue and who gave that approval. If the entity owners or others who have a power to amend the financial statement after the issue, the entity shall disclose that fact. So we discuss about those cases wherein two instances wherein even shareholders approvals are required once it is being approved by the board of directors, or in some specific cases wherein the special committee has been constituted to approve the financial once it has been approved by the board of directors. But for all the practical purposes, the once board approve the financials, it is assumed and it is be construed that those are being approved financials. Updating the disclosure about conditions at the end of the reporting period. So we have already discussed that there are two set of the events that happen after the reporting date and before the financials get approved. So all the material facts needs to be disclosed. For adjusting event, it has to be adjusted in the financial, and disclosures needs to be done wherever required. For non adjusting events, we need to make sure that if at all there is material impact, that needs to be disclosed properly to make sure that the financial statements has that fact captured and it can be interpreted by the consumers of the financial statements. So we have to clearly disclose the nature of the event and the estimates of the impact on the financial effect or the statement. So which means that all their disclosures are required to make sure that the users and the consumers of the financial statement can interpret and take the decisions accordingly. So we'll move to the next slide then. Okay, so we'll quickly speak about some of the examples here, just to give you a quick flavor that how disclosures are required. So for customer bankruptcy, which is an adjusting event, so it requires those are three events: customer bankruptcy, dividend, customer court settlement, and the bonus issue. So all these events are adjusting events, so which means that they require the adjustment in my financial and the necessary disclosure wherever required. Only disclosure is not required here, so it requires the adjustment in my financial. However, there are certain set of the events that only require the disclosure. For example, the fire after the reporting date, non-adjusting event, hence require disclosure only. Dividend declaration after the year end, non-adjusting event, hence require the disclosure only. So wherever we do not require to make an adjustment, it needs to be disclosure. We have to disclose that. But wherever it requires adjustment, it has to be just and necessary disclosure required as per the requirement of the IND AS 10. So we'll move to the next slide then. Okay, so we'll come to the last section and we'll quickly touch base on some of the areas which has impacting on my EPS. So if events after the reporting date affect the number of the shares, like bonus share, EPS for the prior period must be adjusted retrospectively. Absolutely right, because otherwise it would be giving the wrong comparisons. For a typical example, let's say if company has 1 lakh share and let's say my EPS was, let's say, 5, so which means that we were talking about 5 lakh as the base and my as the numerator and 1 lakh as the denominator. But let's say company has issued the bonus share in the ratio of 1:1. So when my 1 lakh becomes 2 lakh, but my numerator becomes the same, so which is the 5 lakh. So which means that my EPS is like 2.5 rather than the 5. And hence, if we try to compare with the previous years, it will be having the higher EPI depending upon the profits for that particular year, which is not going to give the comparative results. And hence, we have to reinstate our EPS for the previous years retrospectively basis the comparative numbers that we are presenting. So this is one of the example. So wherein bonus issue is there, we have to do the adjustments, and that is an adjusting event which requires a change in the number of the share without the resource change. Right issue with bonus element. So we have to do the adjustment, but bonus element requires a reinstatement. But in right issue, it does not require the reinstatement because right issue is a fresh lot that has been issued. So increase in the base itself. Without so there is no entitlement to the existing shareholders. They can subscribe for it, but for that they have to pay the value for it as well. So this is not require any retrospective adjustment. Convertible instruments existing pre of the year. So we have to show the impact on the diluted EPS because there is a potential shares that exist because that gives the right to my debt holders that they have the potential to convert that into the equity share in the future period. New share issued after year end, no impact. Buyback of the share, no impact because these are like non-existing event because there is no trigger that exists on the balance sheet date. uh, Fraud related to the earlier period, we need to adjust it, and it is adjusting events. If it is a prior period error, then it has to be dealt as per the requirement of the IND AS 8. impairment due to the prior period condition, so existing event. A market value change after the year end, there is no impact. So typically the simple underlying process is that wherever there is impact on my EPS, earning per share, that needs to be disclosed, and retrospective reinstatement is only required when company issues the bonus share, because there's a change in number of the share without a resource change. But for other them, it does not require any retrospective impact. We have to make sure that we have to give the impact on the basic EPS or the diluted EPS. For a couple of cases, we need to show the impact on the diluted EPS. And what are those cases? So one example is mentioned here, convertible instruments existing pre-year. So there are like two examples here, which is like convertible debentures or convertible preference shares, for which the right exists on the date of the balance sheet for the conversion. So there's a potential impact of those getting converted into the equity share before the financial statement, and hence we have to record for that potential as well in the books of accounts. So with this, largely we come to the end of this IND AS 10 presentation. We'll quickly move to the next slide to have a quick look at the comparatives with the IAS, which is the International Accounting Standards. Okay, so this is the last slide, comparison between IND AS 10 versus IAS 10. So typically there is no gap as such. Everything is in a line. A few, gaps would be there in terms of the presentation where additional disclosure is required, or some cosmetic changes here or there. But fundamentally there is no gap, and it is fully aligned with the IAS 10. So this is the last slide. We'll move to the closing slide then. This is a thank you slide. So again, I would like to thank all my viewers and subscribers for watching this video till the end. It's my sincere request to please cascade this to all the users or the people you think that they need this and they want to refresh their knowledge and understanding. And please subscribe our channel, like this video, share this video, and let us know for any feedback if you have. And we are going to come up with the next IND AS very soon. Thank you. Stay tuned and goodbye.